Focus brought to you by IG and some crazy risk-off action that we've been seeing in the market. And I thought, who better to bring on than Paul Capetta. Paul, how you doing, my friend?
Good. How are you, Frank?
Fantastic, man. We're seeing some crazy price action across a number of markets. And of course, this is a question that there's no concrete answer to. The environment changes all the time. I mean, we thought that we were just dealing with the crazy employment data that we were getting here in the US and how interest rates and forex and stocks and everybody was going to digest that. And then you throw all this geopolitical strife into the mix as well. And you've got all these different versions of risk-off action that we've seen over the course of not even the last week, Paul. It's only been a few days here, but I want to dissect a little bit of it with you, because no matter if it is employment data being too hot or war in the Middle East, we have seen implied volatility, which is the most people's fear gauge. It's up, and it's at its highest levels the last couple of days since around May of this year, as risk-off action has started to kick in. And maybe you can help to define, there's so many different ways to define risk-off action, but the way that you see it here in the market.
Yeah, sure. So, I mean, for the last couple of days, we've seen basically when you have uncertainty, we didn't know. So obviously what happened over the weekend in the Middle East was obviously kind of shocking, and we didn't know what was going to happen on Friday at the close. So that gets kind of priced in right away. So that gives you some sort of uncertainty. That's why you haven't really seen the VIX kind of give back a lot of it, is because there's just that uncertainty in the market. We don't really know what's going to happen overnight. We're not sure what we're going to wake up to. You have to market prices that in, basically. I can't really tell right now if they price it in fully yet or what's going to happen, because there's a lot of uncertainty right now, but that's basically what happens. And then kind of how this correlates into forex pairs is you end up with these basically flight to safety is how I would describe it, pairs where people want to go when there is basically either a war that's bad and involves multiple countries, or something, basically your kind of black swan event is happening as you kind of look at your trading platform that day. So these are kind of the markets, obviously, where we look at this. Obviously, gold's one of them, but bonds, people tend to go to bonds, and typically U.S. Treasuries on the long side of the curve, but also dollar and yen, and I don't see it up here, but also Swiss franc will also get a little action on the risk-off play. It gets interesting. These they did Monday morning. They were kind of up altogether. Dollar yen was basically flat because of it. But you saw things like euro yen was down, I think 140 points on Monday morning. It gave most of that back by the afternoon after we got some more positive news out of the Middle East. It's since, you haven't seen the risk off move yet, but that is it gave us a flavor of what that looks like headed into the rest of the week.
Absolutely. And I'm glad that you painted risk off or fear, whatever you want to call it, in a couple of different lights. And because that's what we're going to get to here in a second. And I wanted to highlight with the different types of flight to quality, because you might say, okay, well, we've seen a flight to quality to US dollars the last several months, Paul. And in the same time, gold has actually been moving lower. And now in the last couple of days, amid the war in the Middle East starting up, you've seen gold actually move higher. And at various points, yen outperforming US dollars. And it's like, okay, so which one is the one, And of course, there are dependencies here. And to your point, when there's more unknowns, when it's kind of like the stock market is moving lower, and it's because no one knows if this war is going to be a huge deal, a medium-sized deal, or a small deal, not to, of course, belittle all the awful stuff that's going in the Midwest, but you get my point here. That's when you see a gold move higher. Whereas what we've seen a lot the last couple of months, which is not necessarily unknowns, but stock downside on inflation being sticky and interest rates moving higher, then you might have US dollar catching a bid as a flight to quality that is also based around the US performing better than other economies and having higher interest rates, as opposed to gold, a non-interest bearing store of value. Well, if there's risk off action, but it's relatively known and interest rates are moving higher, then why would I buy gold? I'd rather buy US dollars, a flight to quality. So a bunch of different stuff there, but I do want to go deeper on Forex. And I'm glad, also keep in mind that Swiss franc, which can be kind of like a European flavor of flight to quality. And obviously here in the Middle East, there are European ties to everything that's going on, very much closer to there than it is the US or Japan here. And of course, Paul, we would expect to call out the true Forex head, calling out that Swiss franc. Don't want to forget about it. But I did want to look at some of the price action since the VIX hit that high, which was October 3rd, the same day as that JOLTS job opening, was when we saw the peak in VIX, or fear gauge here, and what markets were seeing some of the most adverse price action. I mean, right off the bat, Paul, what we saw on that day was US dollar strength, as all 5 of these major markets have appreciated in not US dollar. The US dollar part of this has depreciated across the board since that high. So that high was US dollar flight to quality, and maybe you can illuminate a little bit of why that was so on Tuesday of last week.
Yeah, so this was more of the interest rate move, right? The interest rates in the U.S. really peaked higher early last week into the basically end of last week. They ripped higher. 10 years was crazy, basically. And the interest rates started to give that back. So what you get in these dynamics is the flight to quality. If they go to long-term bonds, that brings down interest rates. If people are buying long-term bonds, which sometimes will also hit the dollar simultaneously. Mm-hmm. So you get kind of a two-way action there. It's a bit weird because it can happen where these markets don't necessarily have to trade in correlation. You can look back at times where we had risk-off events where basically you see the dollar higher on a day and Treasury bonds are higher, so yields are down. So that's an interesting dynamic that can happen. But basically, it was the straight interest rate play. They've pulled back since, and then basically since we opened Monday to now, we've kind of had some easing of tensions, or at least the market has seemed to try to price in some easing of tensions. I'm not going to try to guess if that's actually going to happen or not, but that's basically what the market's priced in at this point. But you have to be kind of careful with these. You can't go straight risk off because there is an interest rate kind of situation going on in the U.S. There's still an inflation problem. We can't forget about that. I mean, we have CPI on Thursday, which is kind of forgotten right now, but it needs to be paid attention to.
Yeah, absolutely. And I wanted to dive a little bit deeper on the Aussie piece, because this is one that's been closer to its historical lows than others, than the euro or the Canadian dollar or the pound. And, this is really worth noting, the correlation between Australian dollar and the S&P 500 in that vein of, because to your point, these different flavors of fear or risk-off action can make a dollar-yen trade really difficult, because if it's that risk-off action that's based in higher interest rates and fear of higher inflation, then that dollar might beat the hell out of that yen. Now, on the flip side, if it's based around geopolitical fear and all these unknowns, then that yen might stand its ground and actually appreciate against the dollar like it has against the euro, which we'll get to in a second. But what has been a relatively highly correlated, purer play, so to speak, has been this Aussie versus the dollar, as Aussie historically is very risk on. You look at the correlation. This is over the last decade of S&P to Aussie, and it's very green.
Mm-hmm. Yeah, no, you're at 0.5 of correlation right now. Historically, you've been up to 1, where it's basically traded lockstep with the S&P, which is not at all surprisingly. You could call it almost like the equities kind of equivalent of an FX pair if you wanted to. It does move quite a bit more. The magnitude of the move is bigger normally, but Australian dollar has lots of ties to China. Generally, their economy is real. They basically need the world economy to be doing well for them to be doing well. So any sort of conflict, any sort of stoppage of world trade is going to basically hurt the Australian dollars, hurt the Australian economy. So that's where you get that from. and you can see things turn really quickly, and it will bounce back and forth quite aggressively. So it's one, if you're going to trade it, you better be ready for the moves. Yeah.
Very volatile piece, for sure. And so, yeah, essentially, if you're looking for a risk-off trade, maybe long USD and short Australian dollar is more clear than the yen piece or the pound piece or some of these other. But also, if you're looking for a risk-on trade, this is a market that is very close to its lows and probably is the most highly correlated piece to the market turning back to risk-on. And yeah, just to highlight, to conclude here, the different sides of this risk-off trade, a U.S. dollar flight to quality is more confident play if you are looking for risk-off currency plays that are based around inflation and interest rates and yields that are now around 5%, but the unknown is, will 5% be the high, or are they going to go to 6%? If you're looking for that type of risk-off trade, then the U.S. dollar could be your market. And I'll leave this with you, Paul, to conclude the segment. If geopolitical risk is the risk-off trade that you're looking for, yen has historically at least been the piece. And you saw this earlier in the week amid, the Sunday night fear that was coming out of the Middle East and how that was translated to markets. Huge move lower in euro yen, right?
And it gave it all back. That's the interesting thing. And what this kind of does for you is it takes out the U.S. out of it. It takes out the interest rate, takes out the inflation problem. The European Union seems to be about done with their interest rate hikes. Their economy's slowed quite a bit. We get German inflation tomorrow morning, so we'll see how that goes. But if you want to play risk off, it's basically a stronger yen, and the euro takes out that U.S. interest rate piece. If the risk off doesn't happen, and who knows what the inflation print is tomorrow for the European Union, you could see it take off higher. But we are at extremes in this market too, which also makes this very interesting. Obviously, 08 highs are in the 170 handles, so who knows where this one can go. But if you get risk off, you can see the yen appreciate, and this one's an easy one. And we just talked about Aussie dollar, but there's also Aussie yen, which could be an interesting trade moving forward. That one's not necessarily one I'd look at too much, but it could be something to take a look at over the coming weeks.
Absolutely. Well, a couple of different flavors of risk off here in the forex market.